Hello and welcome to the Week in Markets. I'm joined by investment analyst Joe Ford, who's going to talk us through some of the key events that have been challenging financial markets through the course of the week. And there's been really three areas that we're going to focus on today. Firstly, the collapse of the French government. Secondly, a wave of US economic data that comes through at the start of the month. And then thirdly, just looking ahead to the Bank of England meeting in just under 2 weeks' time, where they'll be focusing and deciding the latest interest rate decision. But Joe, let's start with France. France is an area that we don't often speak about on the weekend markets or morning markets, but it certainly has been in focus for financial markets this week. We've seen the collapse in the government. I suppose, can you just talk us through the key developments, and then perhaps we can just focus on what it's meant for markets as well?
Of course. So essentially, if I take you through a bit of a timeline on what's happened in France, they've been running a fiscal deficit, which essentially means they've been spending more than they've been earning in revenue. Yeah. So what they've had to do, there's a new government in, they've had to pass a budget, which was aimed to essentially address this. But the problem is they tried to pass the budget without consulting the rest of Parliament, which doesn't go down well. The other problems with the budget, obviously it had to address this deficit that we spoke about. It was essentially cutting the spending and increasing the taxation, which is not going to be popular amongst the rest of Parliament, essentially, despite it may be addressing the right things. So we've seen that happen. There's been a vote of no confidence in Michel Barnier. And so now President Macron has a problem. Essentially, he has to find a new PM to fill that position. And it would actually mean that this would be the shortest term served by a PM in modern French government.
And I suppose the challenge for France is that they've got a 6% deficit, but European Union rules require governments or countries to have a 3% fiscal deficit maximum. So they are more than double what's required by EU law. So they are trying to address that. But because they have a coalition government where no one party has a majority, then we've seen two of the minority parties actually vote against this. So it is a problem. There's no real quick solution to this. It is down to President Macron in terms of putting in a new Prime Minister, but whether that will help resolve the issue remains to be seen. But if we think about what it means for equity markets, European equities, which is the second largest region within the equity book within the True Potential portfolios, I suppose on the whole pretty positive this week. So despite the ongoing unrest within French politics, European equities have actually pushed higher. When I look at returns as of Friday, European equities are up 3.7% this week. So problem, yes, politically, but not for equity markets. They're kind of looking past it now. It's very much priced in.
Precisely, yeah.
Excellent. So if we move now on to the US, so it's the first week of the month, always get a lot of data coming through. We've had manufacturing data, services data, as well as the labour market report today, this afternoon. Joe, where would you start?
Yeah, so let me start with the PMIs first. And just as a reminder, we speak about PMIs a lot. It's a survey that goes out to businesses to essentially get their take on where it's going, where it's going in terms of the economy for manufacturing and services. Yeah. So starting with manufacturing, it's been contractionary. It's been pretty weak, and it's again the reading this week was contractionary. But you did see a bit of an improvement, so less contractionary than it has been. And this was essentially down to new orders coming through a bit more than what was expected before. Moving to services, it's almost like roles reverse here. Services have been expansionary, really strong last couple of months. And again, stayed expansionary, but less so. And that was really down to actually weaker new orders, weaker employment, and weaker activity amongst businesses. But still expansionary, not much to worry about there.
I suppose I'll just come in there just thinking about, this is a survey. It's often quite noisy, the data. And we focus about the services, which has been really strong for a number of years now. October's print was really strong. November's print was a little bit weaker, and you do get a little bit of fluctuation, but the overall trend is still supportive for the US economy, and it continues to grow at a strong pace relative to the rest of the world.
Absolutely. And just moving through to the jobs data we had today. So we had the non-farm payrolls, which essentially is how many jobs were added to the US economy throughout the month of November. And it came in at 227,000, which is slightly above estimates. I think estimates were around 220,000. So again, really positive in that the US economy is still supported by the jobs market. We did see the unemployment rate tick up just to 4.2%, but when looking into the data, there's actually very little change that would sort of cause any concern. And like I say, it remains at a supportive rate for the US economy.
And I suppose, why do we focus so much on the labour market data and how many jobs are added month on month? Well, it really influences the Federal Reserve, the US Central Bank, their view on the general health of the economy and where they want to position interest rates today, but also over the coming months. And we've got the next Federal Reserve meeting in 2 weeks' time, where they'll be deciding where the next interest rate needs to be. Markets expecting another cut of 0.25%. That's 80% priced within markets, and I don't think this labour market report published today really changes that.
No, I don't think it does.
And let's just finish off by thinking about the UK. I suppose we're 2 weeks off from the next Bank of England meeting, where they're looking to, or the market's expecting them to lower interest rates again by 0.25%. I suppose interest rates have been coming down, Joe, and have there been any evidence of a pickup in demand within the data that you've been looking at?
Yep, so there are really two bits of data that I've looked at this week that were encouraging in terms of the UK economy. The first was actually the OECD estimates for UK growth in 2025. Now, after the budget came through and the Chancellor put through £70 billion worth of spending, they actually raised their estimates to 1.7% in 2025, which is a reasonable amount of growth to have in the UK economy. The second element was actually around house prices. So Halifax released the house prices, and it showed actually the highest increase in month-on-month house prices since June 2022, which if house prices are increasing, it means there's more wealth, more likelihood of consumption, more likelihood of investment within the economy, which is a positive.
And I suppose, looking ahead over the next 12 months, and we've heard from Andrew Bailey, who's the Governor of the Bank of England this week, he's very much aligned to market expectations that interest rates will come down, expected about 1% drop over the next 12 months, which would put the base rate at 3.75%. But this should be supportive for demand and also broader economic activity here in the UK. Thank you very much, Joe, and thank you all for watching. Have a great weekend, and we'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.